the three big things that I like to think about when I think about process and markets are the history, the math, and the behavioral components. And she's awesome at that. So that really, next slide, I think it is slide 5, guys, there. And what we do versus what they do is a big deal to us. You can see that we're not like particularly trying to make fun of, which Josh Crumb, who's up next with Stefan Wieler, will maybe make fun of moving monkeys or something like this. But what we're really trying to say to you is, hey, look, we think we have a better framework. We think we have a better process. So these two guys are great on framework and process. That's why we brought them on together. They also used to work together. Welcome, guys. Thanks for making the time.
Good to be back, Keith. Thank you.
Thanks for having us.
Yeah, so maybe I'll give it to you first, Josh. Looking good. I like the flow, that Canadian-looking flow. Post-NHL playoffs, you look like you could be right there. Can you just give a little context on you and Stefan and how you know each other and why we're having this conversation?
Yeah, absolutely. So Stefan and I have worked together probably for over a decade now. We first met at Goldman Sachs, where I was leading metals research, and Stefan was leading oil research out of the fixed income macro and commodities team. And so I'd say all along we were always, I think, looking at trying to look at the price markets for oil and metals a little different than most people. And I'd say that collaboration has really taken on a whole nother level when we joined up again at Goldmoney and developed a gold price model that we've published. So I sort of tend to focus on the macro structure and metals. But Stefan certainly probably is good, the best there is at energy markets.
Well, and I think that's why I'm so excited about this discussion, whether it's BitGold, Goldmoney, or all of your experience across the commodity chasm. I mean, to really look at something fractally, from a fractal perspective, you have to look at everything all at the same time and be able to remain sober or unaffected emotionally. We've seen people affected emotionally on the topic of gold, which you guys may have thoughts on, but you guys really aren't emotional at all when it comes to your framework, correct, Stefan?
Yeah, I mean, we just basically, our framework is not something we developed in order just to hype something or to give us, it's not a magic machine that gives us trading signals. It really, what we try to do is we try to organize our thoughts. We try to find out, okay, what are the main drivers of gold? And we found out it's actually quite simple. And we basically started with first principles in the sense that it has a cost, and that cost comes in the form of energy. Mm-hmm. And so, we developed that model a few years back. I think we were done with it by the end of 2015, and we looked at it and we said, well, we identified all these drivers for gold, and we think we're pretty much at the bottom for all these drivers. And that's pretty much the point of the model. So you basically look at, okay, what is moving it, and then you can say, okay, going forward, I think we have a bottom here in longer dated energy. We have probably a peak in real interest rates. And we called the bottom in the gold market at around the end of 15, early 16. And I think that has been a pretty good call. But I think what we also saw, again, model-based, is that everything changed probably by the end of 19. That's when we really think the new bull market started.
Yeah, and the game on quote from Crumb is the one that most people remember. I think it was in June of 2019. Am I correct on that, Josh, in terms of what you saw there, and maybe just kind of recap that so that people are up to speed?
Yeah, absolutely, and again, I'll take credit for all of Stefan's work there. But yeah, I mean, ultimately, I know Stefan was updating the model and getting really excited. In fact, as usual, we did this a lot at Goldman as well. You get really excited about seeing something the market hasn't seen, and it's just a mad scramble to get the numbers right and publish something something professional, and then it's my job on Twitter to get emotional about it. So I think that's what we did, and and I think, but at the same time, the Hedgeye process worked in well, and of course, you made the major call at the same time for probably similar underlying structural reasons, but maybe different signals. And so we were quite fortunate to get out in front of that one. But I would say probably more importantly is even what we've done recently, and that's sort of define a range. And in fact, I think back in April, again using this model, using this framework, I was actually able to pinpoint, using Stefan's work, sort of a top, of 2100 in gold, which really ended up playing out quite well also.
Yep.
So again, we're not really, we don't have a business here to promote forecasting. It's not our business. The most important thing I wanted to say with those timestamps is really trying to help explain our process, which of course Hedgeye does great as well.
Yeah, so maybe on that too, Stefan, can you go through why you're talking about TIPS yields? Like when you have this great exhibit in terms of ranges. When I talk about risk ranges, guys, by the way, Hedgeye subscribers, Hedgeye Nation, that's not what they're talking about. They're talking about the range of the value of gold for certain levels of inflation or real interest rates, correct?
Yeah, that's correct. I mean, we can take a step back and simply explain quickly to those who haven't read the research, and maybe we can post the link to this somewhere on the Hedgeye Twitter account or something. But basically what we looked at is, what we found is that there are simply three main drivers for gold prices over very long time periods. And one we call central bank policy, which is actually two drivers. It's real interest rates and it's quantitative easing. And then what the second driver is longer dated energy prices. And we use as a proxy, we use like a 5-year forward Brent price there. And then the last one, and it's actually the least important one, is central bank net purchases. I have to say the least important one in terms of statistical outcome is that you don't have very good data. It's usually very lagged. So it could be that actually that is a more important driver than what we found. But on the central bank policy, so on the real interest rates, if you think about if you have money, really the value of the money is the real interest rate differential you have. And for the US dollar, so if you look at gold priced in US dollar, what you compare your real interest rate on gold to is the real interest rate on the US dollar. And we look at 10-year TIPS there. It's not a perfect measure. And I just updated the model quickly, and I wanted to see how it performed in this crazy time since the beginning of the year. And it has done admirably, but also it actually underpredicts the price at the moment by around $100. And so if you look at real interest rates, I think conceptually that's the right way to look at it. The problem is always how do we measure real interest rates? So if you look at TIPS yields, that's probably not a perfect measure for what true real interest rates are. Because in the end, what a TIPS yield is, it compensates you for inflation as it is measured by the government.
Right.
It's not measured by the market, right? So if the market thinks that that TIPS yields are actually underpredicting inflation relative to how real inflation is going to be, then our model would also probably underpredict the price of gold. I think that's currently what's happening right now. Well, but that's kind of one of the main drivers.
I mean, for me, because we pay very close attention to this as well, I mean, you don't have to have a perfect, because of course it's a lie. I mean, the government's definition of inflation, if it's not a lie, it's a moving target.
Yes.
So let's just say that. But it's all about the rate of change. So it's the bloody calculus of it all. So whatever they call it, it's still, generally speaking, and again, there's some standard error there, but the rate of change of TIPS expectations and the actual price of TIPS is a very good leading indicator on the rate of change of real rates. I mean, it's not so I don't think you have to have the Billion Prices Project in your inflation reading and have everybody agree to that, because they're never going to agree to it at the government level anyway.
Yeah, absolutely. And then, you clearly have to define what is inflation, right? So inflation is different for everybody. Rich people have very different level of inflation than poor people have. And pretty much everybody has experienced a different level of inflation. So by focusing on one level of inflation, you're obviously missing this. So you would have the market's level of inflation. I think actually gold does a much better job to measure what real rates are than the real rates we read out of tips.
Yeah, that's an excellent point that we don't have an answer to. That I think, like, especially if you get down the rabbit hole in terms of the permanence of U.S. job loss and what it means to have real inflation in dollars when you don't have a job and you don't expect to get one anytime soon. And you look at the basket of low-income earning families and what the Constitution is, to your point of what inflation matters to them: shelter, food, medical, in particular, the three of the bigger ones. If you have a car, probably energy price is going to be in there as well. But it's entirely different than what you and I or Josh are going to consider something that would affect our real purchasing power.
Yeah, absolutely. And one of the reasons why we're so adamant in using energy in the model, and why we think that actually makes gold money, is we, if you look at the actual consumer basket, and that, it doesn't really matter your income bracket, all goods have some component of energy, typically in transport, right. But oftentimes in production as well. And what Stefan did in three of his reports was really to define, what is the flow component of energy cost in gold, and not just indirect. But what's the direct cost of blasting and hauling and mining, refining, and we see that it's got a very high energy component because it's so scarce, which makes sense, right? Crushing tons of rocks to get a gram of gold. Now, every other real good in the economy has a similar energy component. So there's going to be reasons why gold is always going to be correlated to that inflation basket that everybody has. But depending on where you are on the income spectrum, your goods basket may be closer to that raw commodity and that raw energy cost, which therefore makes gold or silver or commodity type energy monies good money, or even I'd say the Canadian dollar or other currencies that are tied to the energy economy. So you see that happening, and of course, as you get farther up the income curve, and your discretionary basket includes much more intellectual property, art, and other sort of more intangible values, then it's going to be different. But one thing that I can say, at least up here in Canada, is I can't even get out of Wendy's for two people for less than $20 anymore. So and of course more and more people are in that sort of commodity basket, and so I mean, in our view, I think a lot of these inflation numbers are pretty nonsensical, even before you get to things like healthcare and education and other sort of scarce necessities for this economy. But I think it's very important to define that structure. And again, this isn't, oftentimes market analysts or economists will talk about gold like it's this just bouncing beach ball that's just some sort of human mind construct of money, which is just not true. Just mathematically, in the physics, in the correlations, in the causality, it ties to an inflation basket. And that's what we see the market doing. And that's what we focus on our framework, is understanding why, rather than just, going with these, sort of unanchored narratives.
Yeah, unanchored narratives. Good God, man. I mean, I just went through 6 of them with Liz Ann. Like, the narratives with no numbers. I mean, it's what humans do, though. They want a story. And what's better about nonfiction is that the numbers drive the story. It's not the other way around. And that's in particular with your process, because again, I'd be, if there was an anchor to my bias, if you're to have my process has biases, like I'm anchored to real rates, I'm anchored to the FX market. I don't do anywhere in the area code of marginal rate of change in terms of global energy transition, where you guys have. This is where you're at. For those of you that don't know, I think we had it in the byline, but Stefan's now head of research for one of Europe's largest energy and power traders. So, Let's just wrap that up, and then we'll get to the actual what next for gold itself. Like, what is it that like somebody who isn't? I think I'm like not macro unaware, but I need to know like kind of like what are the most important 3 things to watch in that transfer on the energy side.
Yeah, I'll let Stefan get more specific, but I think what's important from my perspective to sort of convey is just how significant the macro structure is changing. Yeah. I think you've done a lot of that work on the financial side and the financializations and the change of the financial flow of funds. But on the energy side, we also have once in a multi-generational transformation of what's happening in energy. And as one thing that I sort of despise about the academic framework for economics is that there is an under sort of analysis or everyone talks about capital and labor as these broad topics. But ultimately, what really matters in market structure is the flow of energy and information through that capital and labor. I think Professor Steve Keen has a great quote that capital without energy is a statue, and labor without energy is a corpse. So we need to look at the economy as more than just capital. And even when you think about inflation, as I just described in the energy context, the flow of energy really defines our economic structure. And as Silicon Valley has taught us the last 10 years, the flow of information as well. So when we look at that flow of energy, this decarbonization and this trend of which also ties into the financial world with ESG investing and the carbon mandates that are getting put on companies from the world's largest institutional funds. This is going to change capital markets in my view almost completely if it hasn't already. And specifically what it's doing is you're essentially changing where the flows and the source of hydrocarbons are and the economies that build around that. You're changing that to electrification, and the capex. Our former colleagues at Goldman have put out some really great reports this year talking about this energy transition and carbonomics. And what they've pegged the capex at is about $16 trillion. About $1 to $2 trillion a year needed to meet the Paris goals of 2030. And that kind of capital infrastructure is way bigger than cloud and mobile that's driven the stock market of the tech companies the last 10 years. It's way bigger than even the BRICS transition and Chinese urbanization the 10 years before that. So this macro structure of markets, if it holds, really is going to change the markets in our view, or in my view.
It'd be really hard to refute that labor point, by the way. We're at a seminal moment in cyclical time, I guess is what you would call it, where labor's been grossly underpaid, particularly on the North American side, and that's why you're seeing, what you just gave that basic example of what's happening at Wendy's. Well, my brother's got a McDonald's franchise in Winnipeg, Manitoba, and you'd think that he invented the light bulb if he puts Big Macs on sale for $2 for 4 hours. Like, because there's a complete change that's happened in terms of cost of living, cost of labor, expected cost of labor, and that horse has cleanly left the barn. But and we talked about that through different discussions. But Stefan, what would you expound upon in terms of that?
Yeah, so I mean, we are at the beginning, I would say, of a massive transformation in the energy space. And I don't know how we're going to call this in the future, whether it's going to be called the Green New Deal or decarbonization or whatever it's going to be, but it's happening already. And we see it, I mean, the one place where it's happening at a very rapid speed right now is in Europe, where you see a massive transformation of the power sector towards the renewable energy. You have a cap and trade system where prices went from €5 a ton of carbon a few years ago to today it's around €25. You have extremely high targets within the European Union of how much energy, or no, it's not how much energy should come from renewables, but the target is basically how much carbon emissions you're going to save over the next years. And these targets are working, so we actually see a massive expansion in renewable energy in Europe at the moment. The next thing is going to target probably the transportation sector. And also this, what's been going on in Europe will move overseas as well. And it's happening for some. One reason is that governments want this to happen, and on the other hand, it's becoming cheaper and cheaper and cheaper actually to produce renewable energy. But this will create a host of issues which have to be addressed and have to be addressed quickly. So in Europe, for example, it's interesting. We saw an interesting dynamic. More and more more and more electricity is produced from the renewable sources, but the actual capacity is declining. And so you have less and less spare capacity, so to say, with more and more unreliable energy, which may or may not be there depending on the weather. And so at the moment we have to fill this gap with gas, and for a very long time we have to fill this gap with gas, and that's why you see LNG trading is absolutely exploding at the moment, and this is going to continue for many years. And then in the future, you somehow have to bring electricity from when you have it to when you don't have it. And it's not just today the wind is blowing and tomorrow it's not, but you have to bring it, for example, from the summer to the winter. So you have to find completely new solutions to the problem. We think about what could happen is that you build gigantic batteries where you literally store the electricity and feed it back into the network when you need it. Something we don't have right now. The only way we can store any electricity at the moment is with hydro, and there's really not much around, and there's not much built there. So that's just in Europe, and that will expand to the rest of the world. And then you look at the transportation sector, where we're at the beginning, but you can clearly tell that everybody knows that that this is the way it's gonna go. You see all car manufacturer going into that direction. You will see first you will have smaller regions, probably cities, that will outright ban the sale of cars with internal combustion engines. So you will only be allowed to drive in cities with electric car and hydrogen car, and that will force the producers and the consumers actually to shift. And that's about 70% of where your oil goes at the moment. So on one hand, this will impact the demand for the hydrocarbons in the future, but also it will create enormous demand for the materials you need to build that new transportation infrastructure. So there will be extreme shifts and extreme demand growth for certain metals. And that's also will be the bottleneck of how fast you actually can do this transformation. But at this point, this has been set in motion, and this is how it's going to play out. I don't think there is much doubt here. And you see, actually, it's very interesting. Over the past year or so, you have seen pretty much every major oil company announcing that they're planning to become a utility. And at the same time, the utility is actually trying to find out how they are going to exist in this future. Because if you decentralize the power, then the question is, what are the utilities going to do? So this is a once in a lifetime transformation of the entire energy sector, and it will affect every hydrocarbon, any form of energy you can possibly think of.
That's awesome. I mean, when people hear that, they might actually understand why gas is ripping. I mean, that's even U.S. gas. So you watch these things, and you'd say that. Go ahead.
It's the only way at the moment how you can fill the gap. So we don't have the storage capacity. Electricity is different than any other form of energy, that it has to be consumed when you produce it. You don't store it. It's not like you can't just pile it on, right? So you have commodities that are relatively easy to store, like coal, and then a bit more difficult is oil, and then more difficult is gas, and then electricity is almost impossible and extremely expensive. So if you actually taking out stable forms of of electricity supply and replacing it with unstable forms of electricity supply, so unreliable ones, I would call them. And I'm not saying this in a negative way. I'm just saying that this, like, some of the renewable energies are very, very weather dependent. So you have to fill the gap somehow, and that's can only be gas at the moment. There's no other solution to this.
It's a classic, like if you're looking at things fractally, you have these emergent properties start to undergo a phase transition. But what they're really doing is that they're predicting and all part of the flow of the big phase transition. I think that's what you guys are telling me. Am I saying that properly in my own words, or at least it's in my own head, Josh, right now?
Yeah, no, absolutely. And as you know, Keith, about 2.5 years ago, I started investing in this energy transition by building a new commodity exchange to trade LNG and gas, because we think that's going to be the global balancing point for this entire this entire energy transition is in LNG. And so yeah, I mean, and as many things have happened, COVID has only accelerated this transition. And maybe getting back to the conversation we had before we got into the details of the energy transition, it's really the change in the political and market structure that's accelerating this. And what I mean by that is exactly this Green New Deal, right? The fact that what is different this time than, say, when the rise of carbon trading markets and some of the other green markets 10, 15 years ago. The difference is the incentives of the system are all now aligned. So interestingly enough, the Green New Deal, as much as it gets headlines from AOC and this sort of thing, at the end of the day, it's really not, it's not even Joe Biden that's driving this. And in fact, if you look at his policies, I would say they're conservative. The ones that are actually driving this, from my view, are Larry Fink and Goldman Sachs. Jan Hasius now has the same economic policies as Stephanie Kelton or Jerome Powell, right? Or Joe Biden or Donald Trump. This sort of centrally planned what I call the sort of the Chinification of our macro markets. I think has only accelerated with COVID. And so this is now aligned that this is, and this is, obviously these are my views, but maybe Stefan doesn't share them to the extreme, but I believe that's where we're headed, because that's now what's being driven by BlackRock and the institutions, not just policymakers.
Yeah, and it's what you can take this from a nationalist perspective. People looking inward post-COVID, China versus USA being the most obvious example, where you have to create your own, again, renewable flow, to use your words. There's so many different ways that this could work. My biggest concern, guys, is this. I'm basically getting cute. I'm getting cute with this. There could be the last of the disinflation here, because I have a quad 4 calling. You guys know what that is. So you get both the rate of change of growth and inflation slow at the same time. That wouldn't be hard to call, if only because we had such an acceleration in inflation from basically the lows of this year. When you had a negative oil price, it's pretty easy to only go up from there on a longer term basis. So my biggest concern is literally missing, and maybe that's the feedback I get from these hodlers in Bitcoin, is that you're going to miss the bigger move. I don't think I am, because I could change my position like twice a day, 10 times a day or whatever. But the point is that a lot of these longer term issues, and if I have a bearish dollar view that's linked to what you just said, Josh, on MMT, like starting next year or starting at some point late this year, it's like almost the layup of layups. Commodities, like we're talking about a lot of different things. Like Stefan, I think you just said loading it up into batteries. You'd have to do that with what, like lithium or zinc, or you can't do them both, but I mean either or. Where there are a lot of different commodities out there that are under-owned and certainly underappreciated in this framework. Am I correct in thinking it through broadly that way? Fully loaded, like I'm long rare earths, for example, as well.
Yeah, I mean, I think actually that's even that I said this before. I think that there's probably the bottleneck of how fast you can push this shift in the transportation industry. I mean, if you look at kind of at the moment, you have about 1 billion vehicles in the world. If you add all cars and trucks and everything, it's like 1 billion of them, and we are adding almost 100 million every year. Only depends on what source you look at, but it's probably about 2.5-3% are somehow electrified. So it's not a lot, right? But it's going in that direction. Now, the problem is you need entirely different materials to make these cars, whether it's hydrogen or it's a battery power car. And depending on what type of battery it is and what the technology is, we all really don't know yet how this is going to play out. But it has fundamentally different demand for materials. You can make a car almost exclusively out of steel, and your engine, your internal combustion engine, is made of steel. You need a couple copper wires for the light, etc. Just like if you look at just a hybrid car, that already consumes about twice as much copper as a regular car does.
Right.
If you go to a fully electric car, that's about 4 times as much copper. Now, if you really want to go from 2.5 million cars a year to 100 million, so you want to kind of replace the existing fleet with cars that are mostly electric or hydrogen based or something like this, just the amount of copper you need to do this is enormous. And that's just the copper side. So we're not talking about the lithium, the rare earth, and the molybdenum, and the zinc, and whatever you need, and some precious metal you need for fuel cells, etc. So it's something completely different. And I think along the way, every now and then, we bump into massive bottlenecks and shortages of these materials.
Yeah, well, part of them, like I just said on rare earths, for example, like one of the reasons why we own and have been one of the few people that have figured out, I don't know if you guys have own it yourself, but FVAC, which is through a SPAC, Molycorp came back, so it's going to be called Mountain Pass. And, if the DOD in the U.S. decides that we're not taking any molybdenum or any rare earths from the Chinese, there are very few places you can get that in North America. It's not like we're just like loaded up to the gills with a bunch of rare earth mining operations.
Yeah, so there's a number of issues beyond just absolute resource scarcity, and there is a whole supply chain, and a lot of these heavy metals in particular come with their own versions of environmental externalities.
Absolutely.
And these heavy metals, we stopped liking having things like lead smelters in our backyard for all of these reasons. But I think what's beyond just looking at the geologic scarcity and do we have the political will to do this, I think, again, to Stefan's point, it's the long lead infrastructure that matters. So, we're not going to, and I had this conversation a lot back, 10 years ago when at Goldman, we would, every once in a while speak to, say, energy ministers or sort of, planners at the government level. And really the only country that was on top of this 10, 15 years ago was China. There was very few others, and maybe Japan. And one of the interesting things that China was always doing is they were controlling the supply chain of those pieces that we didn't want in the West, right? So if you look at again, zinc and lead smelters, those are almost all built in China these days. So it's more than just the resource; it's the whole supply chain. And I think there's going to be some issues to maintain that $1 to $2 trillion of new energy infrastructure every year.
I mean, the reason why there's no rare earth production facilities in North America is not because there's no rare earth. You probably found this in your backyard, but you don't want to have the production facility in your backyard, and that's why you don't have them. And this is not something you just build overnight, right? So this is something the Chinese have built and basically strategically planned to have. And now we're trying to build an entire economy on something we don't really have the infrastructure for at the moment.
Now I thought, guys, that we're going to and I think the audience may have thought we're just going to talk about gold. I don't want to be myopic ever, particularly when we're talking macro, nonlinear macro here and talking big phase transitions. So thank you for taking me to a place that I didn't have to beat my head over the camera. But I do want to make sure that people get more specific questions, because we've talked so far. You guys have dropped a lot of big things on top of people's heads that they probably weren't thinking about. So if you don't mind, I'm going to go to their questions, and then I'll come back on some of this stuff. Like there's some very highly ranked questions by scoring, like how we score upvotes and downvotes. Thanks. The first one's from Josh from, I think, St. Louis. I think many people believe gold may be challenged in the near term to hold current levels, but how far do you think gold is likely to fall from current levels? And people want the levels on gold, so let's just round up the horses on that and shut the barn door if you guys can and get on to the next question.
Yeah, sure. Maybe I'll start with the core drivers being real interest rates and energy. And maybe I'll let Stefan take the energy one. But in general, the reason I had that 2100 bound within this framework before we get to something totally different in a new currency world, where I think the next level is probably something like 4,000. But I don't think we enter that new regime yet. So within the sort of current general state of that we're in, if you look at where we think the forward curve of oil, which represents a lot of energy costs in our model, where that tops out, again, we don't see it going to $100, $200 a barrel anytime soon. So that kind of puts a top end of the range. And on the real interest rate side, again, the way that inflation is measured, the way that institutions invest in inflation, we don't see a potential in the very near term for something like negative 2.5%, 3%, 4% real interest rates. Now, in that world, that's where, in my view, gold very quickly moves up to a level like 4,000. But right now, it would take a lot to move out of those energy bands or those real interest rate bands that we're currently in. One more point that I would make on the inflation side, because we started talking about it on the labor side. Again, there's two pieces in my mind. Inflation is more than a Phillips curve with just looking at labor. There's two aspects of inflation that come through. Again, one is that energy cost, which gold represents very well for all the reasons we discussed, and that has a high component of all sorts of goods. And of course, the other one is the labor component. So if you look at the new dynamics of again, what I'm describing as this Green New Deal economy, important to point out is labor just doesn't have the bargaining power at all in this MMT world, right? So for us to fix the balance sheets this year, we basically printed 110 million labor years. That's the equivalent of the trillions of dollars that were printed. 110 million labor years. How does labor compete against that, right? So my view is we don't have labor inflation anytime soon if we can just dump buckets of money down from the top of the system.
I thought Stefan was going to say something in addition to that, but that's good on.
Sure. I mean, I can quickly. So when the energy component in our model is, as I said, is longer dated energy price, and if I look what they have done since the end of last year, we were around $65. If you look at Brent, it came off to, I think the low was in like $38-ish. And since we had this great recovery since March, it was primarily the front prices that went up. The back end really hasn't moved that much. So we only went back to, I haven't checked today what it is, but it's probably around $48, $47, something like this. I mean, if you have a renewed sell-off right now, if this is happening on the back of another massive wave of COVID cases or some election turmoil or just equity crash, that can go lower again. But I think it can't go much lower. There's just not that the oil companies and hydrocarbon producing companies, they can't survive at these levels forever. In one of the main producers still is the US, despite the declining production right now on the back of low prices. And there you have an even lower prices, right? So the back end in TI is around $45. And that's not prices where these companies can survive for very long. You can have a pullback. I think that effect would be rather minor on the price of gold. And so there is actually quite a good floor in there for the medium to long term. My view is the same. If you see a pullback on gold, it's probably coming from the real interest rate side.
Yeah.
So I think my biggest concern here is is if equity eventually crash, you could have a similar. We had this twice. We saw this in 2008, 2009. At the beginning of the crisis, you see a rapidly appreciating US dollar, and you see actually nominal rates rising.
Yep.
And you see inflation expectations are actually declining, because when equities crash, like, people start to price in rather deflation than inflation. And we saw this actually in March as well. We had quite a strong pullback in gold when everything crashed. And I think that probably would be a good trigger to get a pullback. On top of that, I think gold probably has gotten a little bit ahead of itself, and I think that correction is mostly due. For me, it would be really if you see again an appreciating US dollar, and the US dollar was phenomenally weak actually over the past 9 months or so, and if that whole thing reverses. With interest, nominal rates are going higher, equities coming off, inflation expectation getting crushed, then you would see the pullback, which, in my view, would be the greatest and last entry opportunity you have into gold.
Yeah, that's exactly how I think about it. I mean, those are the big buying opportunities in gold. Those have been the big buying opportunities in commodities broadly. So you have to be aware of that. Next question, I'm going to have to kind of summarize one and two. Emma from the UK asking a question just on that, on real yields. And a lot of people like to ask it this way. They're like, can the government even let that happen? One, do you guys think that it's up to the government? Do you think that the yield, real yields are going to actually do what the central bank tells it to do, or not? And do you think that real yields could rise or not?
Yeah, I mean, I think from my perspective, again, I think where does inflation come? From a just a nominal, we're going to raise interest rates, or we're going to shrink the balance sheet. I don't see that happening anytime soon.
I don't think anybody. Right.
And even when they were so committed for years and years, they never really did much. And now they're not even committed to it anymore. So I'm not holding my breath on that one. So where does it come from then? Where does the actual inflation come from? It's going to come from labor bargaining power, and it's going to come from energy. And we've talked about it for at least in the the next 6 to 12 months. I don't think it comes from energy. I think demand is too beat up globally for that to happen, particularly in the transportation sectors. Where does it come from? From labor. Again, when we're now committed to a system where we can print money and hand out UBI, I just don't see it coming from labor bargaining. So unfortunately, it's going to keep coming out in the political space in what's happening in social unrest. I just don't see it happening within the system we currently have, where you're going to get significant inflation pressures in the very near term.
That's tight, man. You got that down. I like that.
I largely agree. I don't think they can. I don't think they will let rates appreciate too much. You saw it actually in spring. I mean, they came out full force and basically injected trillions of dollars, literally trillions of dollars into the market. By the way, actually, I looked this up before this interview because I wondered which QE is this we're looking at right now, and that actually tells you the insanity about the whole thing. This doesn't even have a name. They printed actually trillions of dollars, and it's not QE 1, 2, 3. It doesn't have a name. QE 4 started at some point in 2019 in September. And the recent increase in the Fed's balance sheet doesn't even have a name, so they don't even care anymore. They don't even announce anything. They announced at some point that they're basically buying 700 billion, and that's basically it. But I mean, the way I look this, that in a normal recession they usually cut rates by about 5.5%. And if you start at 2%, then you would end up at minus 3.5%. Now, obviously, you can't have minus 3.5% rates, so you're gonna get it in some other form that has the same effect, and it's some form of QE, but they probably have do some more extreme form of QE. And I guess the sort of UBI we're seeing right now is this extreme form of QE. I mean, I don't see a technical reason why they ever would have to let rates appreciate. As long as you're in basically you're printing your own currency and you're borrowing in your own currency, there's nothing that actually holds you back from doing that. You're just destroying your currency, and that's it. But I don't think they can let rates appreciate. I mean, look what happened last time rates started to appreciate. That was long before COVID. That was in 2019. It became a little bit shaky, and there, after several months of actually reducing the balance sheet slightly, they went 180 degrees the other way around and started increasing at the speed which we haven't seen before, not even during 2008 and 2009. So this whole thing is extremely fragile. And yeah, no, rates are not going up. And if at some point you see inflation kicking in, that's really when real rates are going to go lower.
And that's a great point too. That is a great point to wrap up on. Unfortunately, I do have to wrap up because I have the next guest due up here any minute. But thanks for not only making us think. Like again, we have some commonality in terms of our thinking. We think of gold as a currency. It's not a commodity, but we're able to still like commodities. It's amazing. Like there's this big commodity story you guys just walked us through, and that was awesome. I don't think, and thank God you guys don't work on Wall Street anymore, by the way, because I don't think you'd be able to.
If I can say one last thing, if you have like 30 seconds, and I think this is really what gold makes such a good form of money. It's that it's the same companies that mining all these other companies that can actually shift. If we need more money, they can actually make more gold. So it's the time, the labor, and the energy that goes into gold that actually makes it valuable, because you could use the same time, labor, and energy to make something else. So gold is really fully embedded as a money in the economic system as we have it right now. And I think that's why it's successful and has worked with government decree and without for literally thousands of years.
Money, just like gold. I love that. All right, guys, thanks so much for joining us. We really appreciated that. Up next, we have a short seller. He's not a mean guy either, Carson Block.